Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing from Office Properties Income Trust. Think of it like this. If corporate filings were desserts, this one is less about sweet profits and more about trying to restructure its debt. But did they manage to get out of the kitchen? Let's find out. This report is dated March 10, 2025. This is like a snapshot in time capturing important events that the company needs to tell investors about right away. It's all about being transparent, like showing your hand in a game of cards when the rules say you have to. The main point of this report is about debt. It's about new notes or IOUs the company issued. Specifically, they're called 8.000000. Senior means these notes get paid before some other debts if the company runs into trouble. Guaranteed and unsecured means the notes have a promise of repayment. But they aren't backed by specific assets like a building. It's like promising to pay someone back without putting your house up as collateral. These new notes or promises to pay will mature or come due on January 31, 20 has to pay back the money it borrowed. Until then, the company will pay interest at a rate of 8.000% per year. This interest is paid twice a year, like clockwork on January 31 and July 31, where you pay the interest every of 8 clockwork. On January 31 and July 31, 2025, it's like a loan where you pay the interest every 6 months until the final payment date. The new notes are guaranteed. This means that some of Office Properties Income Trust subsidiaries, which are like smaller companies owned by the main company, are also promising to pay back the money if the main company can't. They're doing this together and they're each fully responsible. It's like having multiple people co-sign a loan, ensuring it gets repaid one way or another. Office Properties Income Trust has an option. It can choose to pay off these new notes early before the actual due date. Before March of 2027, they can do it, but it'll cost them a bit extra. After that date, they can still redeem the notes, but the price will be different as set out in the agreement. Plus, they will have to add any unpaid interest. It is like having a loan where you can pay it off early, but there might be a fee for doing so. The agreement for these notes, what's called the indenture, comes with rules that Office Properties Income Trust and its smaller companies or subsidiaries have to follow. These rules, called covenants, place limits on what the company can do. The covenants cover things like taking on more debt, putting liens or claims on the company's property, and selling off important assets. It's like having rules in a game that everyone has to play by. The goal of these rules is to protect the people who lent the money by making sure the company doesn't take on too much risk or give away all its valuable possessions. One key covenant says they must always have total unencumbered assets of 150% of the unsecured debt as defined in the indenture. This is a safety metric for the lender money by making sure the company doesn't take on too much risk or give away all its valuable possessions. One key covenant says they must always have total unencumbered assets of 150% of the unsecured debt as defined in the indenture. This is a safety metric for the lender's money by making sure the company doesn't take on too much risk or give away all its valuable possessions. One key covenant says they must always have total unencumbered assets. The indenture or agreement lists specific situations that would be considered events of default. This is like saying, if you do this, you're in trouble. If any of these events happen, the lenders can declare that Office Properties Income Trust owes them all the money immediately. These events include things like not paying interest or going bankrupt. It's a way for the lenders to protect their investment if the company starts to struggle. This section is basically saying that the details from the first part of this report about the new debt are included here as well. It's like saying, see the first part, it applies here too. Office Properties Income Trust started a series of exchange offers which are like a swap meet for debt. They offered to trade some of their older notes called the existing notes for these new notes, which we have just talked about. This was according to the terms in the offering memorandum, which is like the rule book for this exchange offer. Think of it like trading in an old car for a newer model, but instead of cars, it's debt. Here's the deal. Office Properties Income Trust offered to exchange some of its old debt called existing notes for new debt called new notes. People holding the old notes could agree to this swap. This table shows how much of the old notes were accepted in the exchange and how much of the new notes were given out in return. So for the existing notes that were due in 2026, holders turned in $2,000 worth of those and got $1,000 worth of those dollars and got $5,832. And so for this turned in two trust accepted $20.95 rolls and received all of dollars and got $1,800 and dollars 8 find oldy and dollars and gazan 1,059,000 worth of those notes and got 5,000 worth of those and dollars for fund old debt for $9 for this worth of those and got 1,000 and so for the 59,803,000 and received $6,721,000 worth of those and dollars 14 49,000 The deadline to participate in this exchange offer has passed, so you can't trade in your old notes for new ones anymore. The new notes that were offered haven't been officially registered with the government, so you can't just buy and sell them freely like regular stocks. These offers were only made to specific people who met certain criteria, like being big institutional investors or people living outside the United States. It's like a special invitation-only sale for certain qualified individuals. This is just a disclaimer saying that this report isn't an offer to sell or buy any securities. This section is a heads up about forward-looking statements. The company is saying that some of the things they talk about in this report might not actually happen in the future. They're based on what the company thinks will happen, but things can change. So don't rely too much on these predictions. They are not promises of future performance. This is another disclaimer saying that this report and the attached press release aren't an offer to sell or buy anything. It's like a sign that says, "This isn't a store. We're not selling anything here." So let's take a step back and look at the big picture. Office Properties Income Trust is dealing with its debt. They've swapped some old debt for new debt, and they're trying to manage their finances carefully. This is pretty standard for companies, but how well are they handling it? Office Properties Income Trust seems to be working actively to manage its financial obligations. The exchange offer is a way to push out debt further into the future, which can give the company more breathing room. However, they couldn't get everyone to exchange their notes. This can be a sign that investors aren't completely confident in the company's future. Also, the new debt has a higher interest rate of 8.000. Also, the new debt has a higher interest rate of 8.000%. So it's costing them more to borrow. One of the biggest risks here is the company's ability to manage its debt in the long term. Real estate can be tricky, and if the economy slows down, they might have trouble keeping up with their payments. On the other hand, if they can successfully manage their properties and keep their tenants happy, they could see some growth in the future. Overall, Office Properties Income Trust is in a somewhat delicate position. The debt exchange is a start, but they need to keep a close eye on their finances and make smart decisions to stay on track. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate deep dives. Until next time, keep decoding.